Hello and welcome to Chapter 5, Corporations, Partnerships, Estates, and Trusts. This chapter is on corporations, earnings and profits, and dividend distribution. By the end of the chapter, we should be able to explain the role that earnings and profits play in determining the tax treatment of distributions, compute a corporation's earnings and profits, determine taxable dividends paid during the year by correctly allocating current and accumulated earnings and profits to corporate distributions, describe the tax treatment of dividends for individual shareholders, evaluate the tax impact of property dividends by computing the shareholder's dividend income basis in the property received, and the effect on the distributing corporation's earnings and profit and taxable income. Recognize situations when constructive dividends exist and compute the tax resulting from such dividends. Determine the tax implications arising from receipt of stock dividends and stock rights and the shareholder's basis in stock and stock rights received. And finally, structure corporate distributions in a manner that minimizes the tax consequences to the parties involved. So let's look at this big picture problem here. Plainwell Ice Cream Corporation, a premium ice cream manufacturer, has a very profitable year. To share its profits with its two shareholders, it distributes the following: cash of $200,000 to Waffle Cone Corporation, and real estate worth $300,000 with an adjusted basis of $20,000 to Lewis. The real estate is subject to a mortgage of $100,000, which Lewis assumes. The distribution is made on December 31st, Plainwell's year end. Plainwell had both good and bad years in the past. More often than not, however, it has lost money. Despite this year's record profits, the GAAP-based balance sheet for Plainwell indicates a year-end deficit in retained earnings. Consequently, the distribution of cash and land is treated as a liquidating distribution for financial reporting purposes, resulting in a reduction of Plainwell's paid-in capital account. The tax consequences of the distributions to the corporation and its shareholders depend on a variety of factors that are not directly related to the financial reporting treatment. So we need to identify these factors and explain the tax effects of the distributions to both Plainwell Ice Cream Corporation and its two shareholders. We'll read this chapter in order to formulate a response, or in this case, go through, the PowerPoint in order to formulate a response to this question. Corporate distributions overview. So distributions are from corporations or the corporate earnings and profits. They're treated as a dividend distribution and taxed as ordinary income or as preferentially taxed dividend income. Distributions not treated as dividends are treated as non-taxable return of capital to the extent of shareholders' stock basis. Distributions exceeding shareholder stock basis is treated as a gain from sale or exchange of the stock. There's no definition of earnings and profits in code. It's similar to retained earnings, financial reporting, but not often the same. Earnings and profit represents the upper limit on amount of dividend income recognized on corporate distributions and corporations' economic ability to pay dividend without impairing capital. So let's take a look at this knowledge check. Which of the following statements is not true about earnings and profits of a corporation? It is the maximum amount of dividend income that shareholders must recognize. The notion of earnings and profit is similar to the accounting concept of retained earnings. It is a measure of the dividend paying capacity of the corporation. Or D, even if earnings and profit is insufficient, the entire distribution is treated as dividends. We know that is not true. D, because we just talked about it somewhat. But let's look. Generally, distributions are paid out of earnings and profit and are treated as dividends. However, if the funds are insufficient, distributions are not treated as dividends. They are considered a non-taxable return of capital to the extent of the shareholder's stock basis and are reduced accordingly. If the distribution exceeds the shareholder basis, the excess is treated as a gain from sale or an exchange of the stock. Earnings and profits. Computation of earnings and profits. The calculation generally begins with taxable income, plus or minus certain adjustments. So we have to add previously excluded income items and certain deductions to taxable income, including tax-exempt interest, life insurance proceeds in excess of cash surrender value, federal income tax refunds, dividends received deduction, and then we start with taxable income plus or minus the certain adjustments. So The minus or the subtractions are certain non-deductible items, such as portions of meals. Meals are generally 50% deductible. Entertainment expenses are not deductible. Related party losses, not deductible. Expenses incurred to produce tax-exempt income, not deductible. Federal income taxes paid, not deductible. Key employee life insurance premiums, net of increase in cash surrender value. And fines, penalties, and lobbying expenses are also non-deductible. Some earnings and profit adjustments shift the effect of transactions from the year of inclusion in or deduction from taxable income to year of economic effect, such as a charitable contribution, net operating losses, or capital losses. Gains and losses from property transactions generally affect earnings and profit only to the extent recognized for tax purposes. Thus, gains and losses deferred under the like-kind exchange provisions and gains deferred under the involuntary conversion provisions do not affect earnings and profit until those gains are recognized. Other adjustments include some things such as accounting methods for earnings and profit are generally more conservative than for taxable income. For example, installment method is not permitted. Alternative depreciation system must be used. Also, amortization depreciation prohibits additional first-year depreciation. And Section 179 expense must be deducted over 5 years, 20% per year. Other adjustments are cost depletion must be used rather than percentage depletion. Percentage of completion must be used, no completed contract method for long-term contracts. Amortization of organizational expenses is not allowed. Adjustment is required for changes in LIFO recapture amounts. Intangible drilling costs must be amortized over a period of 60 months. And mine exploration and development costs must be amortized over a period of 120 months. So here's a summary of earnings and profit adjustments. This is page 1 of the summary. You can go ahead and pause here and read through this so that you understand what needs to be added or subtracted. And here's page 2. Again, pause here and read through this. So the knowledge check activity number 2. Henry Corporation had taxable income of $400,000. It had tax-exempt interest income on bonds of $4,000, meals expenses of $2,000, entertainment expenses of $1,000, federal income tax refund of $5,000, and premiums paid on key employee life insurance of $7,000. To determine Henry Corporation's earnings and profit, go ahead and pause and try to answer this. These are your 4 possible choices, and then we'll go through what this calculation looks like. Okay, one thing that I wanted to note here is this should say non-deductible meal expenses. So this is essentially half of the meal expenses. And in that case, we would start with the taxable income of $400,000. We would add the income on the bonds, $40,000. We would also add federal income tax refund of $5,000. Then we would subtract the non-deductible meals of $2,000 and the entertainment expense of $1,000, as well as premiums paid on key employee life insurance, $7,000. And that would get us to $399,000. So you can see that here. Current versus accumulated earnings and profits. Current earnings and profits are taxable income as adjusted. Accumulated earnings and profits are the total of all prior years' current earnings and profits since February 28, 1913. Reduced by distributions from earnings and profits. Distinguishing between current and accumulated earnings and profits is important. Taxability of corporate distributions depends on how current and accumulated earnings and profits are allocated to each distribution made during the year. If a positive balance in both current and accumulated earnings and profits, the distributions are deemed made first from current and then accumulated earnings and profits. If the distributions exceed current earnings and profits, we must allocate current and accumulated earnings and profits to each distribution. So allocate current earnings and profits pro rata using dollar amounts to each distribution and apply accumulated earnings and profits in chronological order. When tax years of the corporation and the shareholders are not the same, it may be impossible to determine the amount of current earnings and profits on a timely basis. So allocation rules presume that current earnings and profits is sufficient to cover every distribution made during the year until the parties can show otherwise. If current earnings and profits is positive and accumulated earnings and profits has a deficit, accumulated earnings and profits is not netted against current earnings and profits. The distribution is deemed to be taxable dividend to the extent positive current earnings and profits can cover that balance of the distribution. So let's return to the facts of the big picture problem. So Plainwell Ice Cream Corporation had a deficit in GAAP-based retained earnings at the start of the year and record profits during the year. Assume that these financial results translate into an $800,000 deficit in accumulated earnings and profits at the start of the year and current earnings and profits of $600,000. In this case, current earnings and profits would exceed the total cash and property distributions to the shareholders. The distributions are treated as taxable dividends, and they are deemed to be paid from current earnings and profits even though Plainwell still has a deficit in accumulated earnings and profits at the end of the year. If accumulated earnings and profits is positive and current earnings and profits is a deficit, net both at the date of the distribution. If the balance is zero or a deficit, the distribution is a return of capital to the extent of basis, and any excess results in a taxable gain. If the balance is positive, distributions is a dividend to the extent of the balance. If the deficit in current earnings and profits is allocated ratably during the year unless the parties can show otherwise. Here's a cash distribution example. A $20,000 cash distribution is made at year end in each independent situation. So you can see the table here. We're not going to read through each one. So we have the accumulated beginning of the year, the current earnings and profits, and what is treated as a dividend. On 3, since there's a current deficit, current and accumulated earnings and profits are netted before determining the treatment of the distribution. Let's look at this knowledge check activity. Which of the following indicates improper allocation of current and accumulated earnings and profits to distribution? When both current and accumulated earnings and profits are positive, then current earnings and profits is first applied to the distribution on a pro rata basis, and accumulated earnings and profits is applied in chronological order. That's correct. We just read that a few minutes ago. When current earnings and profits is positive and accumulated earnings and profit is a deficit, then the current accumulated balances are netted and distributions are dividends to the extent of current earnings and profits. That doesn't sound quite right. Think about that one. Let's look at C. When current earnings and profits is a deficit and accumulated earnings and profits is positive, then current and accumulated earnings and profits are netted and any loss in current earnings and profits is deemed to accrue ratably throughout the year. I believe we read that like 3 slides ago, so that sounds correct. When both current and accumulated earnings and profits are a deficit, then distribution is treated as a return of capital, first reducing the stock basis to zero, then generating taxable gains. Yes, we looked at that earlier. So I believe B is the answer. Let's go ahead and check. Which of the following indicates, the answer is B. When current earnings and profits is positive and accumulated earnings and profits is a deficit, then current and accumulated balances are netted and distributions are dividends to the extent of current earnings and profits. When earnings and profits have a positive balance and accumulated earnings and profits has a deficit balance, current and accumulated earnings and profits are not netted. Distributions are dividends to the extent of current earnings and profits, and the excess will reduce the stock basis to zero and generate a taxable gain if it goes beyond zero.